where the market stands entering 2026 as we move closer to 2026. Many investors are asking the same question. Where is the stock market really going? The truth is simple. The stock market is not just about prices. It is about expectations, economic conditions, and long-term trends. By the time we enter 2026, the market will be coming out of a very important transition period. Interest rates, inflation, and economic growth have all gone through major changes. For several years, high inflation forced central banks to keep interest rates elevated. Higher rates slow borrowing. They reduce spending. They pressure company profits. However, markets do not wait for perfect conditions. They move ahead of the economy. By 2026, investors will likely focus on three main questions. Is inflation under control? Are interest rates stable or falling? Can companies grow earnings again? Historically, when inflation cools and rates stop rising, markets start pricing in recovery early. This does not mean straight-up growth. Volatility will still exist. Another major factor is government spending. Infrastructure, defense, healthcare, and technology spending continue to support certain sectors. This creates winners and losers. The United States stock market remains the largest and most influential in the world. Global money flows still depend on U.S. economic stability. For long-term investors, 2026 is less about short-term trading and more about positioning. Understanding the direction matters more than predicting the exact top or bottom. This video is not about hype. It is about preparation, interest rates, inflation, and the Fed's role. Interest rates are one of the most powerful forces in the stock market. They affect borrowing, spending, and valuations. When rates are high, companies pay more to borrow money. This reduces profits. Stock prices feel pressure by 2026. Many analysts expect interest rates to be more stable compared to earlier years. Stability matters more than speed. If inflation remains controlled, the Federal Reserve does not need aggressive policy. Markets usually respond positively to predictability. However, this does not mean easy money is coming back quickly. The Fed's priority remains price stability. Another important point is bond yields. When bond yields are high, some investors move money away from stocks. When yields stabilize or decline, stocks become more attractive again. Investors in 2026 should watch inflation reports, Federal Reserve statements, employment data. Markets react not just to decisions, but to expectations. A single sentence from the Fed can move markets. This is why understanding policy tone is critical. The goal for investors is not to fight the Fed. It is to adapt. Sectors that may lead in 2026. Not all stocks move the same way. Markets rotate by 2026. Sector selection becomes more important than market timing. Technology remains a key driver. Artificial intelligence, cloud computing, and automation continue shaping business efficiency. However, valuations matter. Healthcare is another strong long-term sector. An aging population increases demand for medical services, equipment, and innovation. Energy is evolving. Traditional energy and renewable energy both play roles. The focus is on stability and efficiency. Consumer sectors depend on employment and wages. If people feel financially secure, spending continues. Financial companies depend on interest rate conditions. Stable rates help banks plan and lend more efficiently. Defense and infrastructure spending remain relevant due to global conditions. Investors should avoid chasing hype. Strong companies with real earnings matter more than stories. Diversification is key. No single sector carries the market alone. Risks every investor must understand. Every market outlook must include risks. Geopolitical tensions can affect markets quickly. Supply chains, trade policies, and global conflicts influence prices. Corporate earnings matter more than headlines. If earnings disappoint, markets react. Debt levels remain a concern. High debt increases vulnerability during slowdowns. Emotions also create risk. Fear and greed cause poor decisions, short-term. Noise distracts from long-term plans. Risk management matters more than prediction. How investors should prepare for 2026. Preparation beats prediction. Focus on quality companies. Understand what you own. Stay diversified. Avoid emotional decisions. Have a long-term plan. 2026 rewards patience, discipline, and knowledge. Markets move in cycles. Those who stay informed usually win over time. Please subscribe for more updates. Thank you.